With inflation currently running several percentage points higher than most bonds are paying in interest, why own them? And with all the deficit spending, money printing, and bond buying by the U.S. federal government, should you be looking for other solutions? Stay tuned as we discuss all that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm one of your co-hosts, Adrian Nicholson, and I'm joined today by Erik Olson. We got another great episode, another informative episode for our listeners today, and we're glad you're here able to join us. We took two articles that we think are going to be really interesting, and we're going to share them with you in our show notes. The first article is Why in the World Would You Own Dollar Debt by Ray Dalio, and the second article is Portfolio Strategy Commentary, What to Do with the 40, and this is by Daniel Phillips. And we're going to be kind of focusing on a lot of different areas with respect to bonds, negative rates, the whole macroeconomics, and it's going to be a very interesting episode. And Erik's going to kind of dive in and tell us why this is going to be an important topic today and kind of give you some interesting concepts. And he's also got a story to really kick things off. So I'm really looking for another exciting episode.
Yeah. Hey, well, by the way, before I actually do that, I just want to give a shout out to Roshan, our erstwhile co-host, who's out and about. So, Roshan, sorry you couldn't be with us to discuss this interesting topic. I bet it would be one that you'd love. But as you listen later, I hope you like it. I also want to say thank you to you, Adrian, and to Roshan from the previous episode in which I was listening as I was out in northern Michigan, actually in the UP, Upper Peninsula, driving along Lake Superior, and I had my headphones in and I was listening to the episode that I had missed when I was at the podcast movement. I guess it was 2 episodes ago, and you guys did the high impact life story about the Special Olympics, and I thought that was so cool that you did that. So thank you very much for that.
Of course, Erik. It was really exciting to share one of my personal stories on creating a fundraiser for the Special Olympics, and it was just really great just to be able to share that with the listeners, and I'm glad you enjoyed it too. I love giving shout outs when I can, and I love just sharing stories when I can. It's always very exciting, and I'm glad this podcast gave me the opportunity to do that. So it's all been good, and I'm looking forward to recording another episode with you today. It's going to be another good one. So you can start us off
absolutely.
And tell our listeners, kind of do the little recap and give a little story too that you talked about as well.
Yeah, and while I'm at it, I'm just going to say for our listeners who didn't hear those previous episodes, now we have an easy way for you to find them. That's to go to our newly built and launched website, which is retirementlifestyleshow.com. You can go there and find all our past episodes, the YouTube versions, the audio versions of show notes, the whole kit and caboodle. So get yourself over there if you haven't done that already, and check it out. So, but I wanted to start with a story to set up why this conversation is important. And first of all, I mean, most of our clients have portfolios that have some amount of bonds in them, and the question is, why do we have those bonds in there right now when at this point the interest rates on bonds minus the inflation rate that we're suffering through right now means that the yield after adjusting for inflation is actually negative. In other words, we call that the real return or the real interest rate, the real yield on bonds right now is negative. Let's be specific. The 10-year Treasury bond, which currently has, or at least at the end of July, had a 1.24% yield. That yield is coming in the context of what also at the end of July was a consumer price index that was, depending on whether you're looking at the core, it's called, which excludes food and energy, or the headline version, which includes those two, is either is 4.3% for the core and 5.4% for the headline. So let's just even use the more gentle of those two, the core CPI of 4.3. If you say I'm getting 1.24% return or yield at least on that 10-year treasury bond, and I then subtract from that a 4.3% current inflation rate, what that means is that I have a negative 3.06% return.
Yeah, Erik, and that's incredible. And you think about it, the purpose of investing is to have money in a store hold the wealth so you can convert it into buying power at a later date. And right now you're talking about negative rates. It kind of just makes you question this and think about it. And that's why we're going to have this discussion today. Because like I said, the purpose of investing is to just increase your buying power in the future on its most basic level. And again, we're talking about having negative rates here and like yields being so low. Yes, the inverse of that is bond prices are kind of hitting their upper limits right now. But again, it's kind of that give-take relationship that we're going to kind of highlight today.
So the two articles that you identified a little earlier in this conversation, Adrian, are taking, I would say, two contrasting looks at the question of whether or not to have bonds in your portfolio. And so we thought we'd lead out with the one by Ray Dalio, because honestly, if you didn't have any other sort of touch points, this one might make you want to wet your pants. Basically, it starts gently or relatively gently by talking about the problem of negative real interest rates on bonds, but it just builds from there. And it gets to the point where ultimately it does provide some solutions, and there are some solutions. But our second article will deal more with everybody calm down, back away from the cliff. Let's have a conversation about, how bad is this really? So we'll provide both perspectives, but we thought we'd at least offer the wet your pants version first, and then help you back away from the cliff. So, Adrian, what are some of the key things that he's talking about early in this article to kind of build the argument essentially against bonds?
I think the biggest thing too is kind of going back to that real rate that you talked about, where yields right now are just at such a low level because, again, there is a lot of fiscal and monetary spending and money coming into the system, which is just pushing these rates down more and more. And again, like I mentioned earlier, the purpose of investing and moving your money in, let's just say, fixed income and bonds is one big thing is liquidity and income, but where rates compared to inflation is causing negative, you really have to begin to question that. And I thought it was really interesting, kind of that example and that story he gave, where like if you locked up your money, let's just say in like US fixed income or European or Japanese or Chinese bonds, it could take almost hundreds of years to get back your original principal. And that right there, like you said, Erik, made me wet my pants. I'm just like, that's just hard to believe just to begin with.
Yeah, I mean, in terms of the hundreds of years. And so his concern is that if we're in this sort of situation, how long will people tolerate it? And what's the next step, or what's the next chapter in this story? So one more, I would say, sort of benign version of this story is that rates stay low, bond prices stay high. Remember, listeners, there's an inverse relationship between the price and the yield of a bond. So if the interest rate of a bond falls, it's the price of that bond rises. Or said differently, if the price of something rises, its yield falls. I think that's actually more the direction of it. On the other hand, if the yield rises, the price falls. So let's leave out the cause and effect here for just a moment. But the point is that if you're at the 10-year treasury is at 1.24%, and yes, granted, in August of 2020, I think it was at about 0.54. So certainly it can be lower than 1.24%. That was 0.7% lower. But unless they start denominating 10-year treasuries with a nominal return that is actually below zero, And by the way, that has happened. And I think I recall Swiss bonds a few years back were actually offering a stipulated negative interest rate at a nominal level, but people were willing to buy them because they felt like, well, there's more safety in a slightly negative nominal yield and an even more negative real yield than some of the alternatives for parking that cash. So, it seems odd to me, but his basic argument is while there may be some instances in which you will see a nominal rate that's below zero, the likelihood is that you won't. And so if the rate can't drop realistically on a sustained basis below zero, then prices really cannot go up from where they are here, or at least not much. And if that's the case, then does it stay in a holding pattern? Does it stay there on an indefinite basis? Maybe the answer is yes, but maybe the answer is no. Adrian, do you recall some of the things he was talking about in terms of sort of the argument for maybe no, that bonds don't stay in that holding pattern?
I thought it was just really interesting, that section where he says, for bonds have kind of been on this 40-year bull market that has rewarded those who were long and penalized those who were short. And I think that was a really significant area of the article. And like we mentioned earlier, just this low interest rate environment has just made bonds at these upper limit prices where it's kind of like you said, is it going to be this holding pattern, or like kind of what's going to be this instance where it either like stays at this or it begins to fall? And I think that's something that you really have to look into more and just consider this aspect of these bonds. And again, a good role that bonds play is that inverse relationship, and that maybe that low correlation to equities, where you don't want to overweight your portfolio in one section compared to another section. That's what that other article that we mentioned discuss. And I think that's going to be a really important area as well that we can talk about.
Well, I think that one of the big points that he mentions in this, and by the way, I think if we didn't say it, Ray Dalio isn't just some guy. Ray Dalio is the founder of Bridgewater Associates, the largest or one of the largest hedge funds in the world. So he has a following and he has a track record, and he's not just some crank who's kind of out there always, Dr. Doom or whatever, with these dire warnings trying to get on somebody's talk show or something of that nature. Instead, he's run a big operation that's been enormously successful. So he has this kind of credibility. His observation is that the way that central banks have been operating, which has been to essentially print money, has been in part a way of providing stimulus for these economies. And the normal thing that an rational investor would do in normal times in response to that stimulus is try to get ahead of it. And as soon as they recognize that stimulus is coming, buy what he calls reflation assets. So, Adrian, just some examples of reflation assets. What would those be?
A common one would be equities. That's the go-to one. But I kind of want to just do a little bit of a summary of what you kind of mentioned, Erik. And in the article, it talks about monetary policy 3, which is the coordination of fiscal policy, is where the central government just begins to borrow and direct money, where Ray Dalio says to those that want to get it. And then there's the monetary policy aspect of it, where central banks print money to buy up this government debt. And this is kind of the stimulation he's talking about. And I think the example is see the economy as a person, and then see the other aspect of it, like the government and the central banks as the doctor, where if the economy's pulse is going down, all this stimulation, this like kind of cures to put money into it to kind of stimulate the economy and have all this money going into the system, into consumers' hands, just to kind of revamp the economy, so to speak, is kind of what's been going on recently. Again, you kind of saw a lot during the pandemic, where it's, again, keeping rates low and putting money into the financial system to support these prices and other aspects of it. And these reflation assets are also key to it as well, to kind of hedge against this. What do you think, Erik?
Yeah. So in the normal time, you're right. So they would buy things like equities, as you mentioned. They might buy inflation protected securities. They might buy gold. But at this point, his argument is that you put so much stimulus into the system and you keep doing that on a sustained basis, the incremental benefit from that stimulus starts to diminish. Whereas for those of us, our listeners who remember some of their Econ 101 class, the marginal benefit from each additional dollar of this stimulus is a diminishing marginal benefit. And as a result, at some point, you have to put in greater and greater infusions of this stimulus or this money printing. And at some point, people say, wait a second, this is crazy. And it's costing us so much to service the debt. Now, by the way, part of the point of creating these negative real interest rates, it's not just sort of an unintentional byproduct in his argument. And he doesn't say it quite this explicitly, but sort of reading between the lines, if you'll allow us to do that here, is that in part it's intentional, because what it does is by allowing you to pay back with dollars that, because of inflation, are worth less and less and less over time, you're having to pay implicitly less and less and less over time to service, not necessarily repay, but service the debt that you had previously accumulated. And so in this sense, it's not as though the idea is, well, let's figure out how to pay off the debt. Instead, it's rather more an argument of how do we just keep the ball in the air or the plate spinning and continue to shovel more and cheaper dollars to service that old debt. And at some point, people say, this isn't workable anymore. And then in his argument comes a somewhat frightening turning point. Adrian, you want to talk about that?
I think also one of my favorite terms, and something that's always important to follow, he mentioned in the article, is when there's this increased supply of money injected into the system, it really moves asset prices, and you can see these bubbles begin to form in certain areas. Mm-hmm. And I think that's also just really like a byproduct of all this money coming into the system. And if anybody doesn't know, a bubble, if you just look at like a stock or like a chart, an example would be just this rapid price up, where it's just going up and up and up. The prices continue to just get supported to this level. And they call it a bubble because in some instances you can see it go down or pull back rapidly. And I think that's also something that he kind of like points out that can really stir in the reader, where all this money in the system, yes, it's to support certain areas of the economy and help kind of rejuvenate it, but it also, the other end of it is like, how long can these asset prices support it? How long does it take to service this debt? And I think you have to kind of see both ends of it. And I think that was like a really intriguing part of the article as well.
Yeah. So it's the problem then of all this money printing and this increasing debt. And by the way, if you just look at the way in which debt globally has exploded over the last decade and a half in particular, and in particularly the amount of debt on the balance sheets of the Federal Reserve, the European Central Bank, and the Bank of Japan, you just say, "Whew, we're apparently, well, just for the record, we're at about 7 or 8 times the amount of debt on the Federal Reserve's balance sheet as we had just 13 years ago." I mean, in 13 years, in the entire history of the Republic, we've multiplied that debt by 7 times in that short period of time.
I thought it was also interesting, Eric. What was kind of your take where Ray Dalio said he's starting to see a little bit of a shift from U.S. bonds to Chinese bonds, where, again, the U.S. has been being one of the world's leading reserve currencies, but all this overborrowing over the decades, investors are starting to look at other areas, international areas, wherever it may be, to look for other fixed income. Again, trying to get as creative as possible and look at different areas. I thought that was another interesting thing looking forward to kind of look into.
Well, yeah. So let's just elaborate on that point, since I won't say it's a side point, but I would say it's not the core point, but certainly want to address it, because as you just pointed out, that is an element of his argument when it comes to solutions, which we'll address in just a moment. But one of those is just to identify, since you've highlighted the Chinese case, what does China do differently than, let's say, the other three central banks or the sort of money centers that I just identified a moment ago, which have served as essentially the world's reserve currencies, namely the dollar, the euro, and the yen. Well, in China, they have a favorable balance of trade and a favorable balance of payments. They also have higher yields on their bonds. And so in this case, his argument is that you can find value, not there's political risk, there's other risks, he's not denying those, but you can find value in incorporating into your portfolio, among other things, Chinese bonds and Chinese credit, because of the higher returns, higher yields, I should say, as well as we pointed out, a more favorable economic balance of payments and such. So, but here's the thing that his argument is, and Adrian, you were going here before, is that not only does it become then a debt bubble, but it becomes a bubble of all sorts of different kinds of what we'd call financial assets, as opposed to real assets. So financial assets, and stocks included. And so at some point, his concern is that there comes a sort of a turning point, or there becomes a sort of a flipping point. I guess I'm struggling to find the right word for this, but it is this moment, this inflection point, I guess, where people start to say, maybe this doesn't make a lot of sense, and someone starts to sell their bonds. And what that does is it creates a kind of cascade. And that's not only true in bonds as bubbles, but other bubbles as well. But his focus here is on the bond bubble. And what that does in his language, not ours, is create traumatic disruptions at several levels. And so now what happens to the societies that have had this sort of traumatic a need to try to adjust, there become essentially political struggles over the division of the now more limited assets if the money printing can't continue. And it just creates a lot of social turmoil, political turmoil, economic turmoil. People understand that the returns to their portfolios will be smaller, that their buying power will be smaller, et cetera. And in the long run, it's just not favorable. So I'd like to turn to his solution in just a second here. But Adrian, is there anything that you want to add to his warning, or at least his concern?
Well, just going off of what you just recently said, he mentions, like, in the article, like, imagine what would happen if for any or all these reasons the holders of these debt assets wanted to sell. And right now, in the article he mentions, there's around 7 trillion of U.S. debt assets of varying maturities. So I think that kind of goes along with your points. Like, there's so much money in this area of the economy that it's just should be monitored, and just you have to, like, think about this certain area of it, because it's such a massive amount of U.S. debt here. I think it's really interesting. But then we can move on to the next section of the article as well. I think it's really good. All and right. Erik, you're right. Just reading this article, it really just sparks attention to this, like, area that, that it's a really big part of sometimes people's portfolio. And again, we're going to talk about it in, like, the 60-40 article. I think is really interesting, where it's like the equity portion, but also the bond portion of your portfolio, just to really be aware and look at different areas and how you can adjust moving forward. I think it's going to be really big.
So Adrian, then talking about his solution, and the word will probably seem a little, the language that he uses for this may seem a little climactic, because at this point, you've been hearing him sort of sound this alarm or sound this concern, talking about where we are in his view, this long-term debt cycle, 50 or 100-year debt cycle. And here he sees us in the late stages of it now, kind of sort of further exacerbated by the advent of this coronavirus and the COVID disease, and then all of the stimulus responses to it. But he would say, if you're thinking rationally, the best approach that you can take is just to be extremely diversified. And so a concentrated portfolio, and Adrian, this is where I would say, some of the conversations I've had with clients and prospective clients lately has just been really interesting. Actually, I was talking, this is actually one of the stories, one of the clients that or prospective clients that I was talking with just last week actually was saying, it doesn't make any sense for me to be invested in anything really outside Amazon and Google.
Wow,
Microsoft and a few of the other big names.
Interesting take. I mean, like Finance 101 is like, you don't want to be heavily concentrated in like one specific company because you have that company risk aspect. But yeah, that's really interesting. I really want to hear more about this story.
Yeah, so I'm using those as sort of the headline on that particular conversation, but it also included the other common names that you see in the S&P 500's big six right now, Apple and Microsoft and so forth. And since those are the ones that are compounding capital the fastest, that's where you should position most of your wealth. And other sort of arguments for diversification in his mind and are theoretically defensible, but in terms of actually growing your wealth, are indefensible. And so, and I, of course, take the view that I'm not only about wealth, the growth of wealth, but also about the protection and preservation of wealth. So it sort of depends on where you are, I guess, in your journey with respect to all of this. But the argument that Dalio makes then as the remedy, or at least the defense, if there is one, against this sort of outcome, is to be as fully diversified as you possibly can. And so that would mean that you would have not only a presence in, and diversification doesn't mean, well, then I'll add Netflix to the other 5 things that I've already mentioned. What it means is that you would have not only U.S. equities, large and small, and bonds possibly, although he doesn't say bonds, but his emphasis would be on certainly international, and then also on real assets. When we say real assets, we're talking about things that you can touch and feel. So that would include real estate. The argument, I think, would extend to gold. Since he explicitly mentions this, I'm not putting words into his mouth. It would also include some of the cryptocurrencies and Bitcoin. Now, this was an article that was published in February, and just last week, I believe it was, or was it even earlier this week, the Senate, if I recall correctly, the U.S. Senate came out with a version of a bill that would, if passed, lead to the taxation of cryptocurrencies in a way that would be the federal government's attempt to either, you could argue, get in on the action or suppress the development of the alternative digital asset space. But nevertheless, in his case, it would be to diversify. And you mentioned earlier, Adrian, as well, some of those would be Chinese credits and things of that kind. So I guess if I would say, to summarize, there are tools out there that are designed to help you have exposure to or participate in, whichever word you prefer there, all of the asset classes that are available on the planet, at least to the extent that they're publicly tradable, and then allow yourself to have that extremely broad exposure.
Yeah,
Adrian, your thoughts?
It seems like there's kind of like 2 takes from it. Diversify across a number of asset classes, for example, equities, bonds, real estate, alternative investments, whatever it may be. And then within those asset classes, try and diversify even more. Just look for all areas that you can diversify, just to kind of just create these protections and hedges in your portfolio. And also, you can look at different components to see what areas of the world you're consolidated in. Are all your asset classes, and you diversify within those asset classes, only concentrated in the US? Is it only concentrated in China, Japan, Europe, whatever it may be? Just getting as creative as possible and looking to these different asset mixes is extremely important. I think that's what he's really going for. And you really need to monitor to see what kind of environment will your portfolio be the weakest in? What kind of environment will your portfolio be the strongest in? And look at all these different economic indicators and these different price levels and see where this money is kind of flowing to kind of make your decision, I think is really important and really beneficial in the long run.
Mm-hmm. And I should mention there's one other thing that he highlighted that we have failed to note in here, and that is if bonds are unrewarding, cash is worse.
Yeah.
Because the yields on cash are even worse, and the inflation is harming them at the same rate as it's hurting the bonds themselves. So on that basis, he would say that that's also partly intentional, that the governments want people to part with their cash and instead buy this debt. And so a way to incentivize them to do it is to make it more terrible to hold cash than it is to hold bonds. So I thought that was interesting as well, although I'm still a believer in holding cash for other reasons. And it's not because of the return it's on that cash. It's instead for the liquidity value of it all. But anyway, there's our discussion of Dalio. So, Adrian, would you be ready to turn over now to the Northern Trust article?
Yeah, this is a really great article and a really informative one. Again, it doesn't kind of scare the reader as much as Ray Dalio does. I kind of call this article kind of like the light at the end of Ray Dalio's tunnel. So this is a little bit better, where it uses the traditional 60-40 example and kind of just looks into the 40 aspect of it. And when I say 60-40, 60% stock, 40% bond. And that 40% bond aspect has kind of been really weighing on some investors' portfolio, where they're kind of not really getting the return they really want or need. And this article kind of says, well, let's look at that 40 aspect and see what we can do to improve the income, the liquidity, to diversify it a little bit more. And it just kind of breaks it down to each of these steps, and I think it's really interesting.
Mm-hmm. So let's also just give people some context for this. So over the last 5 years, I believe, that 60-40 portfolio, and in their case, to make it simple, what they did is for the 60, which is the stock component or the equity component, they used, I believe, the all world stock or all world equity index. So it's not biased toward one or another country. It's certainly not the S&P 500. It's just taking all stocks in proportion to their availability globally. And then on the U.S. side, I believe they were using the U.S. aggregate bond index for the 40%. That portfolio over the last 5 years has returned slightly more than 10.2%. Or in the neighborhood of just over 10%. Historically, that portfolio, if I recall correctly, has returned 9.5%, but their forecast, at least for the next 5 years, is only 3.6. And that's not entirely attributable to the bonds either. So the bonds, they're saying, there's a preview of some things that they talk about later in this article. They think the bond part of the portfolio will still contribute overall 2.3%. So the rest of the portfolio will be coming from the stock side, and there they think there will be somewhat more return, but the blended total return on that on a forward basis for at least a while, they're projecting at only 3.6%. Not great, but not at least at this point as dismal a picture as was being painted by Ray Dalio.
I think it's interesting. Did you think it was interesting where I was kind of looking for somewhere in the article where they kind of touched on rebalancing, or is that just a whole different conversation for later, where I think it's like important to note where, like, let's just say you set up your portfolio as 60-40 and you just have, like, let's just say 2-3 years of your equities just performing really well, where you're going to be kind of overweighted at one point in equities compared to the over bonds. So I guess it's important to note in this section on the role of rebalancing, how that can be important as well.
Yeah, right. I think so. Well, so what they've done in this article, and by the way, it's a group of people there. So you mentioned Daniel Phillips, Michael Dewan, and James McDonald. The three of them, plus some of the other staff, researchers, and others that had input on their article, combined to write this. And this was released in February of 2021. So, but they addressed it from the vantage point of, number one, we want to say that the fears about the bond component of the portfolio that are generally circulating in this discussion of negative real interest rates, they're saying those fears are overblown, and they will explain why. And that they believe that there are some solutions. So let's just outline the big three arguments that they hear, particularly from the client side, about concerns related to the bond contributions of their portfolio. Did you note those?
Yeah,
Adrian?
The first one is
big three.
I'm not getting enough income, and that seems like the common one given the interest rate environment.
How about number two? We'll come back through each of these, but so that was not getting enough income is the number one, or one of the big three concerns they hear expressed.
The second one would be I'm exposed to downside more than upside. And then that's the second issue. Yep. And then the third issue is I've lost my diversification benefit.
Okay, so before we give their solutions, let's just explain each of those problems. So I think it's pretty clear, the first one that you outlined, Adrian, that I'm not getting income. That's because interest rates are so low. So we'll come back to that in just a second. But the second complaint that they hear, or concern that they hear, which you said there's more downside risk than there's upside risk. What do they mean by that?
This one I'm actually kind of interested to hear your take on it, because this is where the role of duration kind of came into this area that I thought was pretty interesting, where just the price sensitivity to interest rate is important to note with bonds to kind of see what your overall protection is. I thought that was kind of a really interesting point in this issue right here that, investors should always be aware of, that, that's not really common. You hear about duration risk.
All right, so let me talk about duration risk, and I'll just precede the discussion of duration risk to talk about the price and yield element here at first. So if there's more downside risk than there's upside opportunity in this, what do they mean by that? So remember a few minutes ago, we were talking about the correlation, or it's the inverse relationship between yields and price of bonds. And so if the yields are already approaching zero, they can't go much lower realistically, at least on a nominal level. Nominal is before the adjustment for inflation. Real is after the adjustment for inflation. We've already acknowledged that they can certainly go negative, very negative on a real basis, but at least on a nominal basis, it's just really kind of hard for us to get our minds around someone saying, "Hey, come invest in my bond. I'll charge you interest to own this thing." It's just that doesn't add up to us. So instead, the thought process is, come on, they can get close to zero, but they're not going to go at a nominal level below zero. So given the inverse relationship, that if the yields can't go much lower, the argument is, then the prices of those bonds can't go much higher. Meaning I might be buying bonds, if I do so, at their highest possible prices.
Where can it go from here?
And so,
exactly, that's very big.
If there's an interest rate shock or an interest rate adjustment, again, given the inverse nature of these, if the interest rates spike higher, then wouldn't that mean that the bond prices would spike lower? So I don't have much upside on the price, but I think, at least in theory, I have a lot of downside risk on the price. And so that's part of their discussion. They want to respond to that, but they also want to bring into their response, as you pointed out, this discussion of duration. What do we mean by duration? So most people think, in the sort of the common language that we use for discussion of a bond is, or at least one aspect of it, is its maturity. How many years or months or weeks or what have you until a bond matures.
An important thing to note is, just like the common theme is, if you're an investor and you're going to be locking up your money for a longer period of time, you would want to get paid more due to that longevity of it, that long time frame where you could be using it in another investment, I think is kind of the overall theme it gets here.
Mm-hmm. So duration is closely related to the concept of maturity length. So if, let's say, something matures in 10 years, it's closely related to this. and then you might say the duration then is close to those 10 years, but duration is affected, and we adjust the duration as to reflect some of the gain that we receive from owning that thing for 10 years in the form of bond income payments. So the bigger the bigger those are, and the faster they come into our hands, the more they effectively shorten the duration of something. And so that's to try to do an apples to apples comparison in bond world. Bond gurus or students of bonds will try to make what would be apples and oranges if two different bonds have not only two different maturity dates, but they also have different interest rates, to try to bring them into one compatible, comparable framework. And make it apples to apples, they use the concept of duration. So a short duration bond, in their argument, or at least restate that, in environments of low yields, which is slightly different than the duration issue, but in environments of low yields, the price and yield sensitivity is higher. In other words, if something's paying currently as a 10-year treasury 1.25%, if it moves 0.25%, the impact on price is greater than if something's paying 10% and it moves 0.25%. The impact on the price of that bond isn't as great by that 0.25% move in yields. So they're saying, we understand you investors in bonds today, knowing that you hold bonds that have already extremely low, historically low yields, are concerned that if there is an interest rate move, the impact on price will be magnified. We understand that, but they have some ways again to kind of help people back away from the cliff on that. And then again, before we talk about the solutions, the third one, Adrian, the third concern that you mentioned, that the diversification is gone. Do you want to elaborate on that?
Yeah, that's a big one, because just historically speaking, like we said, bonds tend to have an inverse relationship, or let's just say a low correlation with equities, where if, let's just say, the equity, and I think Roshan gave us a good example of this, and I think a couple podcasts ago, where the market had a down day, a pretty bad day, and the best performer in his portfolio was the bond element of the portfolio. But again, there's such a low interest rate environment now where these bonds aren't really yielding much. So again, the biggest aspect of this diversification, or the go-to, would just be the equity and bond portion of it as well. So that's also something really investors are considering right now.
Yeah, if historically these things have moved, if bonds and stocks have been, let's say, uncorrelated, or in some cases almost inversely correlated, the concern here is that, but wait a second, if right now bonds are priced as high as they are because yields are low, and this partly the psychology of the stock market is also affected by these really low interest rates, if the Federal Reserve and through the government stimulus programs and so forth, you had a shift in interest rates upward, that would move the value of, or the prices of, bonds downward. Would the stock market also not react adversely to that change? And would not stocks also fall simultaneously with the bond prices falling? So in other words, while normally we expect that they'll have an inverse, or at least a lack of a correlation, wouldn't they in this case actually have a lockstep correlation where the value of the bonds and the value of the stocks dropped at the same time? And that's the concern that people are expressing, precisely because part of what's made the party at the punch bowl of equities so fun for everyone has been this ultra low interest rate environment and all of this. And they're
mentioning that you maybe consider looking at maybe taking on more risk in that bond aspect of your portfolio, maybe looking at taking on a little bit more credit risk to get a little bit more yield. And I thought it was really interesting. This was kind of new, it says hedge funds, specifically hedge fund credit strategies, are another area that investors should be like looking at and for this area of their bond. And that was kind of new to me, and I thought that was a really interesting area of the article that I wasn't too familiar with.
Well, yeah, so those are some of the solutions, but even before they get to saying, so here's what you could do, they just also wanted us to just sort of calm down a little bit. And they said, even though interest rates are this low, bear in mind that there is this attribute of bond prices that effectively yields a higher total return than the nominal interest rate on these bonds. And that has to do with, as you hold a bond and you get closer and closer and closer to its maturity date, at least in their example of this, of people who are flipping from a 10-year to a 9-year to an 8-year to a 7-year maturity date on a bond of this identical interest rate, what happens is that it effectively results in a return that, in their view, at least at the time that they published their article in February, they believe that a 10-year treasury would probably have a return itself of about 2.3%, not the lower return that you're seeing there. So number one is don't be so frightened by it. The second thing they said is, yes, bond prices will move up and will move down. And yes, at these low interest rates, the price response to small changes in interest rates will be magnified, but they'll be magnified in both directions. And if you believe that what we're really in now is a sustained environment of low interest rates because the central banks won't really allow those yields to rise, while we will have, it's likely that we will have, small waves up and down, and with that price responses up and down, they'll move unfavorably at times and favorably at other times. Finally, also, as just one more don't worry commentary, they said, and if you want to talk about the diversification is gone, maybe on high yield bonds tend to have a correlation with stocks somewhere in the 0.7 to 0.8 area. For those of you who remember your correlation unit back in your math class, but bonds as a whole, the aggregate bonds as a whole, leaving out the high yield, actually have, over a long period of time, roughly zero correlation with stocks. And so that their view is that historical tendency for there to be that zero correlation, that hasn't disappeared, and that will remain in place. So with those as some of the, hey, don't worry so much sorts of responses, they do have some prescriptions. And Adrian, you've kind of gotten us into a couple of those. Prescription number one is more high yield, and prescription number two is thinking about hedged credit. Let's talk about the high yield first. Why high yield?
Well, again, that's kind of like the risk and return trade-off, where if you want to get your bond portion of your portfolio to be giving you more return or more income, whatever it may be, you might look on taking on a little bit more credit risk, just kind of toning up the risk a little bit on that bond portion of your portfolio to get that return. I think is really important. And the other one, that hedge fund, the hedge fund credit strategies, I wasn't too familiar with, and that was a pretty new one, but I think it would be pretty interesting for our listeners to go over it.
Well, I'll talk about that in just a second, but let's kind of do a little bit deeper dive on the high yield bonds. So when we say high yield, what we're saying right now is, or at least at the time of publication of this article back in February, high yield was yielding, instead of the paltry returns on treasuries, you were seeing a 4.3% return on high yield, broadly speaking. Now, as you've mentioned, Adrian, there is credit risk. And so credit risk means that in this case, means at least there's some risk of some default. And in this case, it's not default in the technical sense of, hey, we didn't make a payment on a timely basis, but then we caught up. No, it's in fact that some companies are in tough shape to begin with, and they just can't, not only can they not continue to make payments on a timely basis, maybe you never get your capital back. But the impact historically of those defaults has been to subtract a little bit from that return. And I think the number I recall was 1.3%. So if you had a 4.3% average return on high yield, but you had to allow for maybe 1.3 of that to be given back in the form of some portion of the portfolio defaulting, you still have a 3. And that 3 is certainly better than a 1 or a 1.5. So some allocation, not a wholesale allocation, not a sweeping movement of your entire bond component over to the high yield area, but at least some allocation over that should help a little bit. What's more, they emphasize that if you look back over the long history of high yield bonds, the credit quality of those bonds right now is as strong as it's been over the last 20 years.
And I also saw something about the recovery too, where they tend to have these good bounce backs is also another area where historically they've done well.
Oh yeah, most of the time. Now, the credit crisis of 2007, 8, and 9, that was a little different story. It took a little longer for high yield to come back, but on most sorts of those moments where there's a little jolt to the high yield area, within a year or so, it's back to where it had been, and the difficulty of that is gone. So your point, right? The recoveries on those tend to be pretty rapid. So but the other part of this, as you mentioned, is the hedged credit. And when we say hedged, what we mean by that is instead of being long on all of your positions, and I don't mean long duration, but I mean buying something now, hopefully at a cheaper price, hoping that it'll grow in value over time, and then you'll eventually sell it at a higher price. Instead, you can also incorporate short strategies. That means that you borrow something now, sell it at what you think is a higher price than it'll be in the future, and then in the future, your intent is, you're crossing your fingers on this one, that it'll be lower in price and you'll be able to buy it back then. So, in other words, if you're concerned about that asymmetric risk that we were talking about just a moment ago, more downside risk than upside, well, then the solution to that might be to, instead of being long, be short. And now you flipped it. Now the same outlook that led you to believe that you had more downside than upside now leads you to believe that you have more upside than downside because you're short. Adrian, you want to talk about that at all? Otherwise, I can talk about some applications.
I'd love to hear about the applications. I think you gave a pretty good summary of it, and it's just really interesting, all the different components of it. And like you said, this article again kind of highlights that there is light at the end of the tunnel for this bond portfolio, where Ray Dalio kind of paints a little bit more of a grim picture. It kind of makes me wish we had both of these people on this podcast to kind of really butt heads like you and Roshan.
Yeah. Oh, that would be great. A little bit of argument here, a little heat, but the way in which you typically would access these hedged credit strategies in the past, and I would say still to a large extent today, is to use a hedge fund, and not necessarily just any hedge fund, but if you can have a basis on which to make some evaluations of different hedge funds and which ones have shown a proficiency or a talent level for being able to accomplish this, then you can hire them to handle a portion of your portfolio. Most of our listeners, though, are probably not thinking, well, I have a large enough portion of my portfolio to allocate to a hedge fund to do hedge credit strategies. So there have been other ways in which that people have devised solutions to some of this, more through what I would call hedge fund replication. Unfortunately, for at this point in time, most of those hedge fund replication strategies, haven't performed quite as well as the average hedge fund has. They seem to lag on their pre-expense returns by about 1% per year. And then if you add in expenses, they lag by another percent. So there's about a 2% per year lag there. And they're more tailored toward the equity side of the hedge fund world, as opposed to the credit side or the bond side. But what one could do, and I'm not saying one should, this is not a recommendation, it's just an observation about what one could do, is to actually take some bond ETFs, as an example, and short those in a portfolio. And if that, if your outlook is that those bond ETFs, especially longer duration ones, are likely to decline meaningfully in price over some period of time, then if you're short those, though there would be some borrowing cost to you to do so, you might actually be rewarded for doing that. So again, that's not a recommendation. It's just an observation that there are ways of implementing this particular recommendation in ways that don't necessarily involve hiring a hedge fund manager to manage the credit for you.
It shows how creative you have to be, and that there's just so many different like routes and avenues you can take to really just get that income or that diversification or that liquidity that you need. You just got to do your research or have a conversation with somebody just to find it, because there's a lot out there for you to kind of utilize. And I think that's kind of a big theme that I think both of these writers were kind of stating in the articles, where like, look, yes, there's this traditional 60-40, but you just kind of got to break it down and look at all the little areas or different components of it, different asset classes and mixes, to really get that protection or that return you really want. So I think that's all great points there.
And there's one last piece, which is much more, I would say, sort of basic and elementary, but it's something you touched on here as well, Adrian. But it is, even within the category of bonds, diversify. So by that, it's not just into high yield, and it's not or into hedged credit strategies, but a simple way of implementing this would be to have some, and I'll just report what we tend to do, at least in my case, is that let's say a client has a 60-40 portfolio, and that 40% is in bonds, we're talking about here now. One way is to have, at least what we're doing right now, is we don't really have anything in long duration bonds. And the reason is that, or previously we were talking about the sensitivity of bond prices to yield changes when the starting interest rate is low. But said in a different way, another consideration is that long duration bonds have more price sensitivity than short duration bonds do to the same interest rate change. So we're probably I'd say half of a bond allocation is on the intermediate duration. Another maybe third is on short duration, and then the balance is spread equally between high yield and international bonds. And maybe we should be going a little bit further in the direction of high yield and in international.
Yeah, did you think it was interesting when they talked about that 50-year bond? I thought that was a really interesting part of the article. What's kind of your take on that?
Well, so I recall Dalio's discussion of the long return, in some cases centuries to get your money back. But are you talking about in the Northern Trust article that they had a 50-year bond?
Yeah, exactly. Yeah.
Oh, I must have read right past that. Say more.
Yeah, but that's definitely something. It might actually have been Ray Dalio's article, but let me just, I could probably go back, but yeah, we're going to definitely share these articles in the show notes, because again, they have a lot of great information, and they really were a good summation on how you should look at that portion of your portfolio that's allocated to bonds and fixed incomes, whatever it may be, and how important diversification is. So I think those are some great points. Erik, were there any other final points that you would want to bring up before we wrap up?
Yeah, I guess I'll say one. I'll say one more thing, and that is that while I am certainly a believer in the use of passive investment strategies for many categories of the equity markets, particularly the more heavily researched an area is, and by that I mean the large companies in the United States, generally the lower the advantage that you obtain through turning to a talented manager in that area. It's the cost of hiring that talent isn't always recovered by the incremental returns that they can offer. But I would say that on the bond side, the idea of, the sensibility of a market capitalizations index-based approach for stocks doesn't seem to me to make as much sense on the bond side, because really then what you're doing is if you say, hey, we're going to just allocate on an index basis the share of our portfolio that's in fixed income or bonds to those countries and those companies that are the biggest issuers of debt, in a certain way, what you're doing is you're rewarding the people who are the companies and the countries that are the least financially disciplined. And so the more debt that they issue, the more of their stuff you have in your portfolio. So I think in this sense, there is actually, I think, a greater advantage to consider, instead of using index-based strategies, irrespective of the asset class. In the case of bonds, I think there's an advantage to be had, it's certainly in some categories, by using active management instead of a passive approach. And with that active management, at times you can get managers who will, instead of say, hey, all we do is intermediate bonds, or all we do is high yield bonds, or all we do is treasuries, what you'll have them instead say is, we're strategic, we run a strategic bond here, or a total return bond fund. And they can, within that, use short strategies and hedging strategies, and they can rotate from one sector to the next where they see there's opportunity. So in your conversation with your advisor, you might want to have a look at the incorporation, at least, of some of these more active sort of strategic approaches to managing bonds than simply going with the index-based approach instead.
Yeah, awesome, Erik. I mean, I think that, again, this was such a great overview of this section of your portfolio. And again, listeners, if you have any other questions about this topic that we discussed today, we love to answer it. Again, Erik, I really appreciate the info you really gave on these articles. It was some really good content today, and we're going to be back next week. And thank you, everybody, for joining. This has been another episode of the Retirement Lifestyle Show.